Welcome to the Talaria Quarterly Investment Insights for June 2021. Introduction. Large cap US equities are priced to deliver low future returns in the long run. This is not a matter of opinion, but maths. Large cap US equities and US government bonds currently trade in tandem, as both have negative real yields. Both these factors should encourage investors to diversify towards strategies other than growth, regions other than the US, and equities other than bond proxies. Whether or not inflation persists, the balance of probability has shifted more in its favour, while many portfolios remain concentrated in areas most at risk if the market cycle has in fact changed. Investors are overweight equities that lean heavily on capital growth as a component of return, when income is likely to reassert its importance. Talaria Funds offers solutions to these challenges through its attractive valuation, its high income, and its broad diversification. We are grateful over the last year that our process has delivered good risk-adjusted returns. Over the last few months in particular, performance has been strong. This has partly been a function of the change in market cycle that may well persist and that has material consequences. In this quarter's Investment Insights, we will discuss our thinking. 1. Savers are paying. Over the last year, we have argued that monetary and fiscal measures globally have increased the probability of inflation and rising interest rates. These measures reflect a political shift, as fear of inflation and rising debt has receded, highlighting that well-established norms are seen as neither binding nor limiting. The past is seemingly not prologue. In the US, this can be seen in the breaching of the previous red line level of government debt at 100% of GDP, as well as the Federal Reserve's increased tolerance for higher prices via its approach to targeting average inflation. There will be costs from this shift, and savers will likely cover them, either through reduced purchasing power and/or higher taxes. Regarding purchasing power, we suspect there would be less debate about whether inflation will be more than transitory if the stakes were not so high. The broad US equity and growth indices are made up disproportionately of long-duration stocks, whose prices are most sensitive to changes in interest rates. As of today, savers are overwhelmingly positioned for inflation to be transitory. 2. Financial repression. With government debt at globally unprecedented levels and still rising, we're already in a world of financial repression, where the nominal returns savers receive are below the rates of inflation. Today, the real inflation-adjusted yield on all developed market bonds is negative, and the earnings yield on the largest equity market in the world is zero. It's imperative that savers recognize that the future may well not be like the recent past. Relative returns from income will likely increase while those from capital decline. Many recent stock and fund winners have prospered as a function of falling interest rates. As a consequence, savers have an opportunity to reduce risk and benefit from the crowding into a relatively small number of favoured stocks by diversifying into the opportunities the less favoured stocks of the recent past afford. 3. Low future returns. By any measure, bond yields in developed economies are close to historic lows. TIPS, the US 10-year inflation-linked security, currently yields minus 0.83%, explicitly showing the market's acceptance of negative real returns on these treasuries. Given that government bonds are the primary reference points for all other asset classes, the trend of persistently falling rates has been to drive prices up and yields down across a variety of asset classes, including global equities. For example, the S&P 500 has grown in price nearly 7 times faster per annum than have earnings in the last 7 years, to leave it with a current real earnings yield of zero, the lowest it has been since 1985 and the start of the persistent secular decline in bond yields. If we look at the S&P 500 from 2014 to 2020, what stands out is the share price has grown more than 10% annually while earnings are broadly flat. 4. Risk from equities and bonds moving in tandem. With similar real yields on US government bonds and equities, prices of both have started to move in tandem. When bonds fall, US equities fall. Moreover, with an equity market concentrated around a small number of expensive winners, stocks that are highly sensitive to interest rate movements, The US index now relies on US 10-year yields to fall further from their historically very low levels to make progress. As a result, should inflation turn out to be anything less than transitory, many investors will suffer significant and permanent real capital losses. After all, the bedrock of the savings industry, a 60% allocation to equities and a 40% allocation to bonds, rewards handsomely when interest rates are falling, but does not do so in a rising interest rate environment. Furthermore, while the positive correlation of bonds and equities is a new phenomenon compared to recent history, the very recent history has actually been the outlier. In the period from 1970 to 1998, bonds and equities moved in tandem the vast majority of the time. As this is the case, it makes sense then for investors to shift equity weightings towards those equities and components of return less correlated with bonds. 5. The need to diversify. One way to achieve this shift is to reduce exposure to securities where the price paid now is on the promise of cash flow far into the future, cutting back exposure to the so-called bond proxies. There's been tremendous demand and crowding in these duration stocks as bond yields have fallen. This appetite has been heavily based on the concept of the time value of money and the idea that $1 today is worth more than $1 in a year's time. According to the maths, when the discount rate is zero, $100 today is worth the same as $100 in 10 years' time. With interest rates as low as they have been, this has been hugely supportive of the tech sector, which, broadly speaking, makes a virtue of investing for growth and for a payback at some time in the distant future. However, when, for example, the discount rate is 2%, $100 in 10 years' time is worth just $82. With rates at 4%, which is the long-run average on the US 10-year Treasury, then $100 in 10 years' time is worth just $68. At higher rates, long-dated equities are far less attractive. This argues for owning a range of securities that are not dependent on the level of interest rates to generate satisfactory returns. It makes interesting those companies that balance solid near-term cash flows and return to shareholders with opportunities to invest at attractive returns to drive future growth. Despite the strong performance of such companies since September, the difference in valuation between shorter duration and longer duration companies, or the spread between value and growth, remains extreme by nearly any measure. Regional diversification is another way to reduce exposure to the positive equity-bond correlation. With the strong performance of the US equities versus other regions since the GFC, recency bias, the belief that the future will look like the recent past, means it's easy to forget how the cycles of US versus other regions of the world equity outperformance come and go. Because not only are periods of regional outperformance nothing new, but they also afford significant opportunities. For example, Europe at the index level today has a real earnings yield over 400 basis points higher than the US. Given this, is it any surprise that Europe has outperformed the US year to date? In Europe, in addition to the prospect of greater absolute returns, there is also the promise of better protection in the event of falling bond prices, as there is only a very slight negative correlation between equities and bonds. So as of today, a rise in yields would be commensurate with a rise in European equity indices. This is in stark contrast to the US equity market indices. 6. The growing importance of income. Savers have long recognised the need to balance income and capital, but recently this has proven difficult as yields of all asset classes have fallen to very low levels. The only decade where returns to capital in the S&P 500 were as high as the last decade was in the 90s, and as a result, the following decade's return was entirely down to the income component. In short, since the GFC, it's been better to hold the capital and seek income. But with prospective returns low, interest rates at some point likely to rise, this is going to change. In practical terms, income will be a greater component of total returns going forward, whatever the inflation outlook. The issue, of course, in equity markets is where to get such yield. Many equities with higher prospective yields are challenged with all or some of a trade-off between yield and growth. Yields that are unsustainably high, high volatility, and a greater sensitivity to risk-off events. Finding a source of income which diversifies risk, does not result in markedly higher volatility, and changes the mix of savers' returns to more balance the capital and income component is important, but not easy. 7. Here, Talaria helps on multiple fronts. So, given this uncertainty around the medium-term inflation and interest rate outlook, the key for investors to diversify portfolios, gain a greater balance between capital and income as a source of return, and move away from the crowded must-have stocks, Talaria can help. The fund currently has an earnings yield of 7.5%, leaving it less sensitive to movements in the level of 10-year bonds and, by extension, arguments over whether inflation will be transitory or not. Our bottom-up process and price discipline has resulted in only 23% of the fund's capital in the US stock market, and included in our 10 largest holdings are companies from Italy, Brazil, Switzerland, Japan, Canada, and France. So the fund has geographical and sectoral diversification. In addition, we've always recognised the importance of diversifying sources of return. This is why we have a unique implementation process, receiving a minimum 15% contracted rate of return per annum as a result of our commitment to buy a share we want to own. This flows through to the fund in the form of income stream, which is not dependent on a company's ability or management's desire to pay a dividend to shareholders. Not only has this source of income proven stable over time, but it actually increases when capital values fall, thus smoothing the journey for investors. Over the last year, we've enjoyed a good mix of income and capital growth, with an income component of 7.49% within our total return of 17.35%. Given today's backdrop of very low bond yields and high starting valuations in many parts of the equity market, investors need to diversify by geography, reduce duration, and plan for a future where the components of return are more balanced between income and capital growth. Our process for over 15 years has been delivering exactly that, and it is needed today more than ever.